Hi, hello everyone. This is right after lunch. I hope everyone feels refreshed instead of sleepy, and hope our conversation can, be interesting enough. And so our, uh, our session is mainly about how HSBC support Hong Kong innovation, technology innovation development. So we have different kinds of products and services can support the entrepreneurs and investors. So here we have my colleagues, each representing different products. So I will first let them to introduce themselves and a little bit more about their business units. So, Harry?
Good afternoon, everyone. My name's Harry Jarman, and I head up HSBC's Credit Solutions team for Greater China. So my team does two things, basically. We provide financing, and we provide financing to the GPs, and we provide financing to the portfolio companies. And we've been doing this actually in Hong Kong since 2019, so built up quite a reputation, a lot of landmark deals, and very excited to share a bit more with you in today's session.
Kim.
Hi, everyone. My name is Kimberly. I'm the Associate Director of Investments under HSBC Global Asset Management. I think I've had the privilege of working with all members of the panel in some way or form. So the venture business for asset management, I would say, is considerably young. We were founded in 2021 by a leadership team that had previously established and ran strategic investing activities 10 years prior. We have a little bit over $150 million under management today across two products. The first being a climate tech-oriented venture capital fund focusing on opportunities in the US and Europe. And the second being the FinTech fund, which is where I sit under.
Great. Nice to meet everyone here. My name is Louisa, and I head up the HSBC Corporate Ventures team in Asia. We're the CVC arm for HSBC. What that means is, we make minority equity investments into innovative technology companies. So if you're wondering how what we do is different from what Harry does and what Kimberly does, simply speaking, we usually only work with equity and equity-like products compared to debt-like products, and then compared to what Kimberly does in asset management, we mostly invest off balance sheet, and everything we do is mostly strategic. So usually looking at two buckets, things that are around fintech, and then things in emerging technology where we believe it will have a long-time impact to the financial sector. So I think something we're quite proud to say is after we make the investment, 80% of our portfolio companies have multi-year commercial contracts with the bank. So it's certainly something the team spends a lot of time on to make sure the startups we invest in have continued success within the bank. So yeah, being with the bank for 3 years, but been investing in the Hong Kong startup ecosystem for close to 10. Yeah, very happy to be here.
Good afternoon, everyone. Welcome. My name is Stratos. Most likely, I have the most difficult surname to pronounce at this panel and perhaps in the whole event. I'm head of digital policy for Asia Pacific, working with Group Public Affairs at HSBC. I joined 3 years ago, and in my current role, I look after the bank's policy advocacy and regulatory engagement in the region, with a strong focus on data, digital assets and currencies, and artificial intelligence in Hong Kong and other markets. I also look after our 3-year partnership with Hong Kong Science and Technology Park, which is a partnership that aims at promoting and growing Hong Kong and Greater Bay Area's fintech and innovation ecosystem. Thank you.
I'm Carolyn Chen, and I joined HSBC almost 2 years ago when Silicon Valley Bank went bankruptcy. I was leading SVB's China business before that. And so I joined HSBC Innovation Banking together with around 900 former SVBers together. And here we build innovation banking. We aim to continue to serve innovation ecosystem, the investors, the entrepreneurs, with SVB's business model. with our understanding of this ecosystem of investors and then entrepreneurs. And here in HSBC, we have a wider global network and more products here. My colleagues are here, and we aim to continue to serve this innovation ecosystem. Hopefully, with startup entrepreneurs to grow, you'll take us as your partners. Thank you. So now I will ask my colleagues to give more. I think I will ask questions for them to let them explain more about their products, and I will also leave a couple minutes for everyone to ask questions if you do have. So start from who is next to me, Harry. So yes, I know you HSBC launched venture debt product. You know, this is a very familiar name for SVB. This is what SVB famous for. And I think maybe not everyone in this ecosystem understand what is venture debt. Can you explain more, and how do we, select the companies? What is our criteria for working with the companies, providing them venture debt, and what's the major difference between traditional loan?
Yeah, thank you, Carolyn. I'm delighted to answer that one because it does cause a bit of confusion. I think venture debt really fundamentally is providing non-dilutive financing to VC and PE-backed companies to extend the cash runway so that the company can invest in the business, can defer another equity fundraise, and grow the valuation by growing revenues. And that, therefore, obviously means it makes economic sense for the companies given the elevated interest rate that we charge for the risk profile, and also the equity warrants that sit alongside these loans. I think when it comes to the equity warrants, these are important because they actually help to align the interests of the debt provider, HSBC, and the shareholders and the founders in terms of trying to grow the business. So that's fundamentally what venture debt is. We've actually been doing venture debt since 2019. Our lending book actually in Hong Kong is about $1.3 billion US, so quite sizable. Very diversified across sectors, but it wouldn't surprise you that a good chunk of that, so about 50%, is to the fintech sector. There are other sub-verticals within that, particularly insurtech, but that's where the majority of our exposure is. I should also say that venture debt is one of the solutions that we offer portfolio companies, but we also provide revolving, shorter-dated, working capital-focused solutions to companies where it makes sense. And another solution that we provide very much in this vein, and is particularly important or relevant, I should say, to fintechs, is off-balance sheet warehousing facilities. And we've done numerous transactions in this space for the likes of Cubital and Funpark, who are alternative lenders, and also Dowshore as well. So not just venture debt, we have other tools in the armory. I would also say as well that although I've just talked you through very basically the three solutions we offer, we do very much take a solutions-led approach and a bespoke approach to all of the transactions that we do. We really try and get under the hood of the businesses that we are looking at, really understand the dynamics, and try to come up with a solution that really does add value and provides a workable solution to the company. It leads me on to the next part of this, I think, which is how does our due diligence process, our underwriting process, differ from conventional lending? I think it wouldn't surprise you that we don't focus too much on the balance sheet because most of the companies that we look at tend to be asset light. Having said that, obviously cash is a key component that we will look at, and we do prefer B2B businesses, so we do look at that receivables book and the quality of it, the buyers. But fundamentally, we are taking a forward-looking analysis of these businesses, not a last 3 years of financials, positive cash flows. We're very focused on the value creation of this business, the differentiated position in the market, its competitive universe. How can it scale to where it needs to get to EBITDA positivity? Because that's what we're very focused on, that pathway to profitability. We will also look at the investor syndicate as well, which I think differs obviously from a conventional analysis. we want to see, particularly for companies that are very much in the cash burning phase and not expected to break even for many years in the future. We really want to understand that investor syndicate. What's their track record? What fund have they invested in? How much dry powder do they have? How willing are they to support this particular portfolio company? How strategically important is it to them? We'll also then, by extension, look at the fundraising history of the company. How many rounds has it done? How many dollars has it raised? Who's come in? Who's stayed into the investor syndicate? So these are just some of the ways that we will look and underwrite the transactions that differ fundamentally to conventional loan.
Thank you, Harry. Actually, I have a follow-up question for you. We all know that the fundraising market is very challenging these years. And so we saw a lot of requests from entrepreneurs to seeking loans or venture debt from us. So what is the best timing for them to access venture debt to submit this application? So I know timing is a key.
Yeah, it's a great question. We see so many good businesses that have come to us at completely the wrong point in time. We are taking substantial risk. We're obviously taking venture risk, if you like, but we are not equity providers, and our upside is not unlimited. It is really capped at that interest rate that we're charging, and then there's a very small, very, very small percentage that's linked to the warrant. So we are very focused on the downside. Will we get our money back? Will we get our interest back? And so coming to us when your cash runway is less than 12 months, when it's maybe 6 months, is really the wrong time. Your business could be a cracking business. It could be making great strides and having great traction with buyers. But that's just not really a position that we can take, that sort of lender of last resort, if you like. Much better to come to us, ideally concurrent with a live round. And I think people who've done it the best have threaded the needle by sort of securing a facility with us on some conditionality of a fundraise with a minimum amount. They haven't actually had to pay for the loan because the loan is not live. They've then used that loan agreement and shared it with prospective investors. It's given the investor base a lot of confidence that someone has underwritten this business and is prepared to provide credit facilities to this business, and obviously helps drive that competitive tension during the equity fundraise. And then obviously, assuming they raise X dollars, and we can evidence that, then the facility's live and away they go, and they've got all of the liquidity that they needed for the next 12, 24 months, whatever it happens to be. That is the ideal time. Obviously, you can do it post a raise, but then I think the focus will much be on delaying the draw of our facilities for as long as possible, because of course you've raised expensive equity, you need to put that to work. So that would be my advice to anyone here in the audience who's part of a startup. Go concurrent with a fundraising round.
Thank you very much. Yeah, I've been talking to the investors, to GPs a lot in the past over a year, and we know fundraising is difficult for investors and for startup companies. So the GPs, the VC firms, spend more and more time with their portfolio companies, helping them to survive, to grow. So my question is to Kim. So what your team does to support your portfolio company beyond investment?
Yeah, absolutely. I think that's a great question, Carolyn. I think that one of the biggest advantages that we have as investors is the fact that we are a part of HSBC Group. And I think in a similar fashion or a similar way that I think Louisa I think runs her portfolio management kind of activities, we fully take advantage of that. We very proactively try to facilitate commercial or business development opportunities between our portfolio companies and a part of the bank that we think could really benefit from the products and services being offered by our invested companies. We're really proud to say that 4 out of 9 of our portfolio companies are actively providing services to the bank as a vendor, or are in the process of delivering POCs that could hopefully lead to long-term commercial engagements. So again, that's something that we really work very hard to achieve on behalf of our invested companies. And maybe to illustrate this with a concrete example, Our team led MediConson's Series A in the, I think, the end of kind of 2023. For those of you who are unfamiliar with MediConson, they're a Hong Kong-based insurtech company that provides automated cashless insurance claims for kind of a network of hospitals and medical providers across Asia. And they also provide an AI model that helps claims assessors mitigate fraud, abuse, and waste. So shortly after our investment, we introduced them to HSBC PayMe and HSBC Life because we saw very clear synergies between what MediConson has built and some of kind of the tech kind of and roadmap, the tech needs of those entities. HSBC and MediConson and PayMe recently announced a partnership back in June that provides PayMe users with discounted health and wellness services provided by MediConson's network of clinics, which is really exciting. And HSBC Life and MediConson are in the middle of a POC focused on claims innovation. And I think that really kind of illustrates the value that we try to provide to our portfolio companies beyond the initial investment, of course.
Thank you. We all observe that the Hong Kong government in recent years has been strongly promote and support innovation ecosystem. And we all believe that the major sectors here in Hong Kong is fintech and healthcare. So this is also your focus. So what's your view on Hong Kong innovation ecosystem?
What's our view on the Hong Kong innovation ecosystem generally?
What do you see the future of this?
I think what I would like to do is, take the opportunity to kind of clarify kind of areas of focus for the fund, because I think the name of our fund, which is the HSBC, Asset Management Financial Technology Venture Capital Fund, is a little bit misleading because we do invest more broadly beyond fintech. As some of us may be aware, one of our kind of, I guess, anchor LPs is an Asia-based life and health insurer. And so naturally, there also is a very strong emphasis on insurtech and digital health and categories kind of adjacent to those sectors. And also maybe just to elaborate a little bit more on our strategy, we are early stage investors. Our sweet spot is seed to Series A. Average ticket sizes for us range from $1 to $5 million US. And geographically, especially at this point in time, we are laser focused on Asia, but would be happy to speak to international companies with a meaningful business presence in either Hong Kong or Singapore. In terms of maybe kind of the state of the ecosystem and some of kind of the nuances that we're seeing around fundraising, I think there definitely is, especially in the context of Asia, a lot of VCs that are focusing more on early stage companies, and definitely a slight aversion to kind of larger ticket deals. And again, this is probably due to a combination of factors, including kind of richer valuations that we're seeing in the market, and I guess the broken exit escalator that has resulted, and just generally much more, just a lower risk appetite for later stage rounds. And on the kind of, I guess, other end of the spectrum, I think touching on Harry's territory, there are amazing kind of venture debt investors that are providing financing solutions for kind of growth stage companies. However, as I think Harry alluded to, the expectations and the risk appetite is a little bit different. They're expecting companies to come to the table with stronger unit economics. There's a much higher threshold for recurring revenue. If a company isn't profitable, there has to be a clear path towards profitability. And very understandably, there is greater comfort when there are larger names, institutional investors on the cap table. But I do think that a lot of kind of growth stage or growing stage companies do not meet those requirements. So there definitely is kind of a bit of a funding gap between those stages. I think what we do to support our portfolio companies is try to create that bridge to international investors. And I think this is definitely made helpful by HSBC's international network and global presence.
Thank you very much. So the next question is to CVC. So we all noticed that in the past 1 or 2 years, CVC play more and more important role in innovation ecosystem. Like in US, we see Magnificent Seven, they play a big role, especially in AI. And we see the same situation in China, like Alibaba, like Tencent, and SenseTime. So for HSBC CVC, so what is your investment criteria? Do you think that the synergy with HSBC is a very important criteria for your investment?
Sure, thank you, Caroline. Definitely. I mean, we call ourselves the corporate VC arm, so everything we do must have a strategic aspect to it. So the way we think about investment is, obviously financial return is one metrics, but similarly, even more importantly, I think it's the really understanding what are we bringing to the startup and what are the startups bringing to the bank. So I think maybe a little bit different from kind of the example Kimberly gave is actually most of the companies we invest in have existing relationships with HSBC. Whether they're a vendor, we're already using their solution, or some sort of like partnership, white labeling of technology. And because of that, I think our investment focus is probably a little bit narrower. And if I were to break it down, it's really kind of thinking about 2 buckets, right? One is fintech, and within fintech, it's really these Horizon 1 kind of companies that can create immediate impact to our business, whether it's and helping us enter a new market, helping us do a certain product better, bring us cost efficiency. So we have investments in companies in digital lending that's helping the bank to do data-led lending a little bit better. We've invested in companies that use AI to do financial crime screening. Once again, we have millions of dollar contracts with them where they help us process all the bank's financial crime screening. So these are examples where it's kind of easy to understand. These are like vendors, these are tech partners to the bank, and what we try to do after we make the investment is really how can we expand that relationship to beyond a home market. And I think that's what a lot of startups value in the relationship. It's like, say if we invest in a India-based digital lending company and we've co-built some solutions in India, if that is bringing value to the bank, then very quickly we want to see how we can replicate that in our home markets in UK, in Hong Kong. And for India startup, that's tremendously valuable when you have an anchor client who's bringing you to the new market. So that's kind of one bucket. And then the other bucket of focus in emerging technology is, there's a couple of key themes we look at. One is AI. I think that's a hot topic of even this whole JUMPSTARTER conference. But the bank is having a lot of existing AI use case and moving on to Gen AI and thinking about how to move that into production. And in fact, like 90% of Fortune 500 companies have already used Gen AI in a production use case, right? So I think that's commanding a lot of investor interest. AI companies today command $9 trillion in market cap, right? So even for us, I think looking at all the investments we did last year, more than half of them are in AI. So within AI, we're really looking for specialized technical capabilities where we can plug into the bank's own AI stack. So invested in a company called Contextual, where they're a pioneer in the RAG technology. So and the founder is actually the inventor of RAG that's been used in all the LLMs. We invested in a Hong Kong homegrown AI company called Fano Labs, where they do speech to text transcription in a very highly accurate way. So it's either this or we're looking at AI companies that's going into specific verticals. So another example, we invest in a company called TechWolf that's using AI for kind of talent discovery and talent upskilling. So, our HR team is actually using the solution and helping us kind of improve talent mobility within the organization. So yeah, I think AI is a big one. Quantum is another huge one that we're spending a lot of time on, and we think, it's going to be one of the, most transformative technology in the 21st century. So those are kind of some of the. We try to stay very focused into things that can actually, make an impact to the bank today, or, 5 to 10 years down the road, have a significant impact to financial services industry. In terms of stage, we are fairly stage agnostic. We've done anything from Series A to pre-IPO. So I think one thing we try to, one criteria that we spend a lot of time understanding is how enterprise ready the company is. Whether you're a pre-IPO company or whether you're seed or Series A company, we're looking for founding teams, and we're looking for a business that really understands how it is to sell into an enterprise. And it's, for anyone who's tried to sell into HSBC, it's not for the faint of heart, right? So we want to look for a management that has the experience, who understands how you move from a POC to pilot to, commercial contract to implementation, how to navigate multiple stakeholders within the bank, and how to manage your own business cash flow, because selling to enterprise is very lumpy. So I think that's one common criteria we look for across the investments we do, whether it's early stage or late stage.
Thank you. I still remember several years ago, I was in a conversation in a seminar. We're talking about what kind of CVC's role can play. So people are thinking that is the two-sided sword. In one way, it has deep pocket, can continue to support the company. In the other way, that, like in US, I heard that there are not a lot of not many startups around Amazon, because any company grow up, Amazon will build it or acquire it. So what's your view on CVC's role in developing an innovation ecosystem?
That's a great question, and I have to pitch that to a lot of founders who are doing very well and who's like, why should I take money from a corporate? I think there's really twofold. One is thinking about the ecosystem. I think there has been stats now to prove that actually having corporate backers in the ecosystem brings a lot of resilience to deal flow. And if you look at the kind of the downturn we've been having in the last couple years, you can see very obviously that the number of deals that with corporate backer has jumped a lot. I think now something like up to 20% of all VC fundings have a corporate backer in them. And that's really goes back to the fact that CVCs have a strategic angle. So even when the overall market is slow, when the overall market is down, as long as there's that synergy, as long as there's that collaboration angle, CVCs are still very happy to participate. And I think that's evident from kind of the deals we've been doing. I think in a very hot market, we tend to play a more follower role. We participate in a round, but we're typically not leading. But looking back in the last probably 3 to 4 years, a large portion of our deals, we are the only investor or we are leading the round. So I think that brings a lot of resilience to the ecosystem. And then I think from the startup side, I think, as Kimberly mentioned as well, we focus a lot on what we bring to the company as well. So typically, when we make an investment, we put someone from business to sit on a board or take a board of service seat, or sometimes they just simply join the company as like an industry advisor. And that actually brings a tremendous know-how from the industry into a tech company, because a lot of companies we invest in are founded by technologists or people who are really strong in product, but they don't necessarily know the pain point from a customer point of view. So that brings a lot of kind of know-how into how the company should think about the product direction. And then similarly, I think it's really just being an anchor customer in this company, even during downtime, is very important. And I recently saw some statistics that actually said companies with corporate backers are half as likely to go bust in a downturn. And actually, when they exit, the exit multiples tend to be higher because I think with the corporate clients staying and having a long-term alignment brings a lot more kind of value to the company. So I think that's something startups can have a think about the values that the corporate can bring to you.
Thank you. So we have various kinds of products support the innovation ecosystem. Now the question about data is a very important question. So we're talking about data a lot in recent years. So Stratos, so what's your view on the importance of data in the development of technology innovation?
Thanks, Caroline. First of all, let me start by challenging one of the most successful narratives around data, which says that data is the new oil. Now, I have some objections from an analytical point of view. Data is infinite, whereas oil is finite. Oil is also fungible, but data is not. However, when we say data is the new oil, we also have to admit that this expression underscores the importance of data as a strategic commodity. And one reason because this is true, and it does so, it is because data is not just an enabler of today's technological innovation. It is actually the key enabler that differentiates today's innovation compared to previous phases of innovation. And it does so in two different ways. First of all, today we have massive amount of data combined with impeccable quantum power and also increasingly advanced capabilities in terms of data analysis. Now this, together with public cloud deployment and also our ability to transfer data cross-border, can be transformative for further development of artificial intelligence, especially at the space of generative AI that requires massive compute power. Another very good example of how data can enable innovation is open banking, which allows individuals, corporates to share data across through different service providers, mostly with the help of APIs. These bring significant benefits to customers, but also improves the financial services industry by promoting transparency, innovation, competitiveness. Now, a second way that data define today's innovation is the fact that these opportunities, of course, come with certain challenges. Growing customer expectations, a regulatory landscape that in many instances can be quite complex. Data proliferation alongside with the use of AI, machine learning, public cloud, all those, if we top them with, unfortunately, with certain cyber incidents, they have put the spotlight on data management. So the question here is, how can companies, how can firms leverage data vis-a-vis innovation in a way that innovation will support their business planning, will help customers, and ultimately bring added value to societies? So here we're not looking for just a solution, looking for a problem, but innovation that really makes a difference. So companies, they simply need to understand their data better, because simplified data estates leads to better data analytic capabilities. And this in turn helps companies support the clients and act accordingly in a way that will cater to the business needs, but also to the customer's interest. At the same time, this ensures that data are more resilient and more safe.
Yeah. I still remember several years ago when I was back in ICB, so our US team trying to produce a market report. So they have been producing market report on China and the European market, very well received by the market, but not about China. And we try to work with a large institution in China. and to produce the same report about market on China. But then there is a question about data localization. So we understand that there is a growing trend that regulators and government are producing restrictions for data free flow and offshore storage of data. So Stratos, I know your team has been working a lot on this topic, so supporting data free flow while meeting the criteria of regulators. So do you have any experience to share with us or advice?
Well, the ability to move and store data across border and do this in a secure and safe way is critical for the functions of multinational companies, the financial services industry, and broadly the global economy. At the same time, this is a very important condition for companies in order to store and manage the data with a safe and secure way. Today's capabilities, storing data in a virtual way with the deployment of public cloud, but also using sophisticated encryption techniques, allow us to, again, store and transfer data in a secure way. Free flow of data allows us at the same time to optimize our services and support better our customers. To this end, we understand that regulators face, of course, their own challenges, and they need to make sure that people's expectations on privacy is being addressed, which makes absolute sense. And that is why we always advocate for free flow of data in a framework that will be adopted by policymakers and regulators under certain broader conditions and principles. The first one is that we always support regulations that are risk-focused, outcomes-oriented, and technology-neutral. We also believe that this cannot be addressed by regulators working in silos, but we believe that this can be better concluded in a way that will involve collaboration between regulators, government, industry bodies, and of course, market participants. Therefore, we support this further collaboration. It's also important that we strike this fine balance where innovation and investment meets also expectations around privacy and compliance requirements. So this is what we believe is the best way to move forward in a way that will ensure data safety, secure data governance, but also innovation. However, this is not always the case, as you mentioned. Yeah. In early 2023, to give you some numbers that showcase that unfortunately data localization is on the rise, according to OECD, there were more than 90 data localization specific regulations in more than 40 jurisdictions. So this is quite a lot. And we see governments and regulators in different regions, in the Americas, in Europe, in Asia, who actually try to ensure technological sovereignty. In essence, this is an attempt to make sure that they retain control on data sovereignty. This eventually leads to fragmentation and obviously comes at the expense of efficiency in the financial services industry, but also more broadly, because it's important that individuals and companies can, again, share data safely, cross-border, but also through different industries. So to wrap up, this is an area that we have been advocating for free flow of data. We see positive signs occurring. A recent example, well, not so recent anymore, is the UK-Singapore Digital Trade Agreement that also supports free flow of data. And we're working globally with regulators, industry bodies, and peers in order to promote safe and secure storage and transfer of data across borders.
Thank you. Thank you for sharing. So we're right on time. And is there any questions from our audience for our speakers? So time for questions.
There's a speaker over there, Caroline.
Yes, please. Anyone can ask.
Volunteers.
Hello. Thank you so much for the great sharing. I have two questions. So I think Caroline also touched briefly on Hong Kong's promotion on being innovation and technology hub. for quite a while already, and this year they also stretch on that. And I'm sure most of the panelists have seen a lot of startups in Hong Kong and also in Asia, probably in Greater China as well. There has been quite a lot of, like many people say that Hong Kong hasn't been the greatest market for startups. For the ecosystem, and also many people say there hasn't been a lot of like great startups in Hong Kong. So I want to see like what's your view like for the past few years, have you seen much changes? And also in terms of an ecosystem, comparing to maybe like Singapore's or like China, how do you see Hong Kong have kind of like what's our edge and what are some of the challenges that Hong Kong still have? Another question that I'm curious about is because HSBC obviously is a like super global company, and you guys mentioned a lot about being CVC, and a lot of those investment are strategic investment. It's not just looking for exit, but also for the collaboration within the bank. But for such a big global company, is it the collaboration mostly if it's investment in like a Hong Kong startup is more kind of like a local collaboration, or does it scale up to the global kind of like operation, and how do you manage to do that in such a like large corporation? Thank you.
I can get started, and then we'd love to hear other panelists' perspective. I think on your first question, that's a really good question. I think it's a pointed question. I think the reality in Hong Kong is like if you look at kind of in the past, the evolution is there has been good and scaled up startups coming out of Hong Kong. But the challenge in the past has always been people are like, okay, the market is relatively small. If you speak with any VC investor, they're like, we're looking at billion-dollar exits, right? Like, so how do I back a company operating in Hong Kong but can generate me like $1 billion in exit? And so a lot of entrepreneurs starting in Hong Kong would face the dilemma of, okay, then do I start in Hong Kong and then expand into China, or do I start in Hong Kong but then target the Southeast Asian market? And so that has always been a difficult question because either path is not straightforward. Hong Kong, I think from a language perspective, tend to, and the kind of consumer behavior tend to follow a little bit more similar to the Western market, but then in terms of spending ability and like spending behavior is also very different from Southeast Asia. So there is a natural difficulty for a Hong Kong startup to then try to go into Southeast Asia. Now, obviously, there are examples of success, and there are companies that's grown really big into both China and Southeast Asia. But I think one trend we've been seeing a lot in the last probably a year or so that we are spending a lot of time kind of deal sourcing around is this idea that there are actually a lot more interesting Chinese entrepreneurs now that are taking the know-how they've built in China, but setting up shop in Hong Kong and employing local teams, taking the talent from the previous generation of Hong Kong startups and building new companies in Hong Kong. I think that the idea of Chinese entrepreneur going overseas is the main theme. And if you speak with any Hong Kong or China VC today, that is the main area where they're looking for opportunities. Is like there are people who's build massive companies in China. Now they're taking the data, the know-how they have, and setting up brand new companies in Hong Kong and targeting rest of the world. So that's a really interesting trend. We're looking at quite a few companies that's of that sort that we're very excited about, and we see them really now scooping up the good talents, the resources that came from years of the Hong Kong startup ecosystem and congregating them around like these new ideas that have potential to reach the world. So that's kind of on the first point. And on your second point, I think one thing we really try to work on a lot as a CVC is how do we help the companies really grow from a single market to multiple market. I think we're quite fortunate in the sense that Hong Kong is a home market for HSBC. And I think in terms of like tech adoption, product development, Hong Kong market also tend to have maybe the most budget. And so I think the Hong Kong business tend to be very, very forward-thinking in terms of like, what are the new customer experience I need to build out? What are the new journeys? What are the new technologies I should be adopting? Because, I think HSBC role in Hong Kong is, quite a dominant retail and commercial bank, right? So I think we have that natural advantage where the Hong Kong business tend to experiment a lot, and that gives a lot of opportunity for local startups to work with HSBC Hong Kong. And obviously there's also the sister bank of Hang Seng, which is, in a sense, even more agile in, working with startups. And a lot of times the other markets will actually look to Hong Kong to see, what are the new experiences you're doing? You're now able to do, like digital lending in a certain way. And then usually that's the way they start adopting and expanding into markets. So, we do have one investment in Hong Kong, and we started off by using the solution in the Hong Kong market only, but now, we're showcasing it to Singapore, we're showcasing it to UAE, which are other big markets of HSBC, and the markets are very willing and very happy to look at the success case of Hong Kong business and see if they can actually follow. So that's one way we try to do that.
Thank you. Any idea?
Yeah, maybe I can piggyback off of Louisa's second point. Our team especially has a lot of proximity to HSBC Life. They're a very kind of important stakeholder to us, and naturally we do, give them access to our portfolio companies, but also introduce them to kind of other ideas that we're seeing in the market. I think as Louisa mentioned, HSBC and HSBC Life by extension have such a dominant presence in Hong Kong. So Hong Kong naturally tends to be the starting point for any sort of engagement. But once you are able to kind of proof out a specific kind of use case in Hong Kong, there is opportunity to obviously expand to kind of other markets where, for example, HSBC Life does have like a meaningful market presence or game. And we've seen this through kind of a recent example. One of our portfolio companies completed a very successful POC specifically for Hong Kong with a kind of a smaller population set, and shortly was able to expand to Macau, to India, to Singapore, and other markets where HSBC Life does have an active presence. But I think to Louisa's point, Hong Kong is the natural starting point, and you have to kind of prove out that there is kind of a viable use case before being able to kind of expand through the networks of that business.
Maybe I'll just add a couple of points. I think, Louisa, you touched on it, that you can't ignore the addressable market in Hong Kong. But I think if you look at it another way, on a per capita basis, actually Hong Kong's been punching well above its weight for a long time. If you look at the number of VC-backed companies per capita, the number of unicorns per capita, it's actually more than India and mainland China. So that's definitely, a huge plus. But I would say on the deal flow side of things, so looking at portfolio companies as lending prospects, there is no doubt we've seen a big shift from sort of the homegrown Hong Kong scale-ups, let's call them scale-ups, to much more of a majority focus on China startups coming to Hong Kong and using that as their offshore platform to grow internationally, be it still to the west. I mean, there's some great stuff still going on in biotech, or indeed to Southeast Asia. So that's definitely a notable change we've seen over the last 4 or 5 years here in Hong Kong.
Stratos.
Just 2 thoughts here. We can talk about a lot of things when it comes to Hong Kong's advantages as an innovation hub, access to talent in Hong Kong, but also cross the boundary, being China's super connector. I think one of the distinct advantages of this city, one of the many reasons why I love the city so much, is the connection, the networking opportunities and the synergies that you can find in the city. Startups working together with the government agencies and the industry. One very good example is the 3-year partnership, again, I mentioned it earlier, that Hong Kong Science and Technology Park, city's biggest technology ecosystem, has signed with HSBC, which is a 3-year contract. We work with a number of tech ventures within this context on a number of initiatives spanning from something very practical. We're giving them problems and they help us find solutions which we then support and commercialize them, providing investment opportunities and also advising, even connecting tech ventures with our international corridors, further enhancing also Hong Kong's role as an international financial center. This year we have been working with tech ventures, connecting them with Saudi Arabia, with some really high profile POCs being secured over there. So I think this is good. This gives a good glimpse of how different market participants, different forces support further Hong Kong's growing ecosystem. Is everything perfect? Well, of course not. But I think the city is very well positioned vis-a-vis its peers. I don't think it's Hong Kong or Singapore. I think it is Hong Kong and Singapore. Every city has its own distinct advantages. And we need to collectively keep working in order to further boost innovation and fintech ecosystem in the city.
Thank you. Thank you for the great question. And thank you for our panelists. Thank you. So